Hi, thank you for watching Dig Into China. I'm Dong Shang. If you have not done so already, please subscribe to my channel. Thank you very much. For almost a decade, Alibaba embodied China's economic miracle, sustaining a dizzying pace of growth and approaching trillion-dollar valuations. That spectacular run officially ended in early August, when Alibaba reported its first ever decline in quarterly revenue. The milestone is a reminder for investors that after a government crackdown that wiped a large chunk of its market value in 2021, Alibaba is a shadow of its former self. Like the rest of the country, Alibaba is grappling not just with an uncertain regime, but also COVID-0 and a consumer crisis that's testing the stability of the world's #2 economy. Because of the lockdowns, second quarter this year is one of the worst quarters since the pandemic. China narrowly escaped economic contraction in the second quarter, when rolling COVID lockdowns depressed spending on everything from online content to apparel and electronics. Much of the hit on the economy in the last quarter was concentrated in April, when lockdowns were most widespread. The financial and export hub Shanghai was locked down for some 2 months until the beginning of June. More recently, local governments across China have grown more adept at controlling COVID-19 outbreaks swiftly and with fewer disruptions than in previous months. Retail sales rose 3.1% in June from a year earlier. Retail revenue in May fell 6.7%. In April, it plunged 11%. So retail in China has shown improvement lately. Retail sales for Alibaba grew 3.1% in June versus 12% a year earlier. That translated into expectations that the revenue from its bread and butter China commerce division would grow barely 1%, its worst quarter on record. Even Alibaba's cloud division is flagging. Its revenue is projected to expand 14% during the April to June period, but that's the second lowest number in about 6 years. In the US, tech companies such as Amazon also reported a slowing growth recently. Inflation and global uncertainty around issues from Russia's war on Ukraine to the persistence of COVID-19 has made individuals and businesses more cautious. In China, stalling growth has propelled tech companies to focus on cost cutting and optimization. Executives said Alibaba would continue cost control in coming quarters. Alibaba has hired more than 6,000 college graduates this year, but its overall staff has shrunk. As of June 30th, Alibaba had 245,700 employees, down more than 5% from December's workforce. Alibaba has faced intense competition in its core domestic e-commerce business from companies like JD.com, Pinduoduo, and ByteDance, Chinese version of TikTok. To play defense, the company ratcheted up spending in new areas such as discounted goods and grocery deliveries. Other than pandemic control policies, tech sector also faced with additional regulatory headwinds, and it is a more structural and a long-term trend. Chinese authorities clamped down hard on e-commerce, car sharing, food delivery, and gaming. These regulator headwinds have reset growth expectations for the industry last year, but Alibaba has taken a harder hit than many of its peers. There was the tax evasion probe into celebrity live streamer Via, who once single-handedly moved $1.2 billion of goods during Alibaba's November 11 online bonanza. Then, China's technology watchdog suspended ties with its cloud business for late disclosure of a major software vulnerability, spooking potential clients. In June, lipstick king Li Jiaqi became the second major personality to vanish from Alibaba's Taobao. And just last month, cybersecurity experts linked Ali Cloud to China's largest cybersecurity breach. This breach leaked the records on 1 billion residents from Shanghai's police database. Ke Yan is a Singapore-based analyst with DZT Research. He said, it used to be the case where investors bought Alibaba and Tencent shares, hoping their dominant positions in e-commerce, social, and gaming would create a synergy with their newer business and a vast swath of portfolio firms. But that's a long-lost cause since the government tightening. Chinese tech executives have warned investors repeatedly to prepare for a new reality of slower growth. But the downbeat projections paint a gloomier picture than many feared. As COVID lockdowns paralyzed business activities in cities from Shanghai to Shenyang, China's once reliable economic engine has lost steam. Though regulatory pressure on Alibaba is easing in China, it is growing in the US. Days after Alibaba said it plans to apply for a primary listing on the Hong Kong Stock Exchange, at the end of July, the US Securities and Exchange Commission added Alibaba to a list of Chinese companies at the risk of being delisted from the US exchange if their audit papers cannot be inspected before the spring of 2024. US regulators have been demanding complete access to audit working papers of New York-listed Chinese companies, which are stored in China. Beijing bars foreign inspections of working papers from local accounting firms. The US rules give Chinese companies until early 2024 to comply with auditing requirements, though Congress is weighing bipartisan legislation that could accelerate the deadline to 2023. We will see if China is serious about wanting to resolve the audit issues with the US. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.